Good morning, everyone. Jeff Kennedy here. Merry Christmas. We're Friday before Christmas and got a little Christmas present from KBS Strategic Opportunity. Many of you have probably received this packet in your mailbox, and man, there's a lot of it. It's wrapped in a lot of uh, legal mumbo jumbo, it seems like. But I'm excited about this and the near future for this REIT that we are invested in, and I alongside you, because this is the beginning of some real liquidity opportunities for this fund that has really performed fantastic, and I think is now poised to do even better in the coming year and even beyond that if you as an individual investor elect to stay in it. So they're going to produce some opportunities for us in 2018 where they're going to start giving us quarterly liquidity options. A pretty significant amount of the portfolio is going to be available for that. So that's all good. That's good news. But I don't want to delve too much into that because we could really get in the weeds, and I don't want to bog down your Friday here before the Christmas weekend. I would like to go through this paperwork you have though and try and simplify it for you because there is a deadline that needs to be met if you want to elect something other than the default election. So what has happened here is they've sold a bunch of properties into this newly formed REIT over in Singapore. Apparently, there's huge demand for U.S. commercial real estate over there. Lots of money looking for a better home, and so they had a great IPO, and they sold 11 properties that had reached their full potential. Really, they become fully um, uh, occupied, essentially 95% plus occupancy in these properties, and so they're stabilized. That's the term I was looking for, and so that's not a fit for a strategic opportunity REIT that is looking for value and opportunity to raise the value of the overall portfolio by buying value properties. A stabilized property is not considered a value property. It's not going to produce those double-digit rates of returns we've been seeing over the last few years in this portfolio. So they sold those properties and they've got to do something with this cash, and they're going to produce a special distribution as a result, which is what this is all about. Now, um, they also, as a corollary to this, they've uh, last year they floated a bond on the Israeli market at a good interest rate that allowed them to buy some more properties that have already accreted to the bottom line of the portfolio. So that's all good, but the covenants on the bond require them to keep a certain amount of equity coverage on for that bond and cash flow and so forth. So they're going to have to spend some of that money from the capital gain, the sale to the S-REIT, and invest in some properties they've already got identified in the pipeline that will help do that and meet the criteria set by the fund. So they only have so much cash they can pay out, which is why the options are here. So um, first of all, this is going to be paid out in January, but it will be on your 2017 tax bill. So if you own this in an IRA, that doesn't matter. If you don't own it in a Roth or an IRA or something, then pay particular attention to this. Your situation is going to be a little bit different, and I'll address that in just a little bit. So what they are asking you to do is, if you want something other than the default option, to check one of these boxes and send it in by December 29th. Now, why would you want to check one or the other box? If you're in an IRA, I suggest, unless you just have to have some cash right now for some reason and we can't get it from some other place, go ahead and check the all stock election box and send that thing in. If you're in an IRA, again, I would suggest right here on the front of this form, check the all stock election box. Okay, and that's what I'm going to do. I own this in my Roth. I'm going to take the shares, and then if I want to cash out next year, I think it'll be a better opportunity to do that and get more cash because um, if, there's not enough cash to go around for everybody to do the all cash election. And if everybody just doesn't even turn the form in, basically what's going to happen is they'll pay out 20% cash 80% stock. So if you do nothing, that'll be what happens, and that's fine. But if you're in an IRA, I'd suggest going and taking the stock because um, the NAV price, the new printed price for it, it didn't move up that much this year. Um, so I think it's really kind of a buying opportunity. I'm going to go ahead and take the stock option myself because I think next year's appraisal will be much higher. So um, in an IRA, I suggest take the all stock election. If you're not in an IRA, if you're in a non-qual account of some sort, a joint, a TOD, individual, whatever, however you own that, and you really need some cash, you could put all cash election. I know I've got one client's been talking to me, they're buying a house, they could use the money. So um, he's going to elect all cash and see what happens. That there's no guarantee that you'll get all cash. It's likely going to default to something less than 100% cash, depending on how many people elect the all cash option. But again, if you're in a non-qualified account and you have to have cash here soon, remember it won't be paid out till January. But check the all cash box and then see what happens. Maybe you'll get 30 or 50 or 100% cash for this $3.61 a share distribution. Um, but but it's likely it'll be less than that in some way or another. Again, if you do nothing at all, then you'll get probably something like 20% cash and 80% stock. Um, a couple other things here that I wanted to cover. And I got that already, and it's going to be paid in January, but it will be deemed to have been paid in 2017. So again, and for you non-qualified owners, that is, if you own this in your non-IRA account, it will be a tax bill for 2017. So you will want to at least take the default option there, if not an all-cash election as a non-qual owner, because you're going to have a tax burden that you may need to pay out of the proceeds from this. However, there is a possibility that this will just be a return of capital because so far we haven't had enough distributions to get our cost basis all the way to zero. Therefore, it may just be a non-event tax-wise. It may just lower your cost basis, and once you sell, eventually you'll have to deal with the taxes on that. So that you need to consult your tax professional on. I'm not that guy, but I can tell you that it's unlikely there will really be a tax bill just due to the fact that it'll probably be return of capital at this point as we work their cost basis down to zero. If you have any more specific questions about that, um, give me a call. Hopefully this answers the questions because we're only in here today. Uh, you, if you got to get a hold of me, the girls know how to, of course, and we can ask those questions. But again, if you're in an IRA, I suggest all stock. Check that box and send that paper on back in. If you're in a non-qualified account, definitely go for the default at least, or the all cash election if you need to have the cash, just in case you need to take care of the taxes there on that. All right, hopefully that's clear as mud. A lot of stuff. I know there's a lot to read. Definitely read that, but if you don't have the time to read it, hopefully this advice will help you to sort that out. Hey, I'm excited about what's going on in this REIT and looking forward to seeing good things from it in 2018 and beyond. So thanks for listening and Merry Christmas, Happy New Year. We'll talk to you in January. Take care.